Money. Let's talk about money. So many people are afraid of it, or they think it is too complicated. That is not true. Money is a tool. It is a tool for freedom. It is a tool for security. It is a tool for living a life you love. You must understand this. You work hard for your money, day in, day out. But is your money working hard for you? For most people, the answer is no. Their money sits in a bank, earning almost nothing, losing power to inflation. This has to stop. You deserve better than that. You need your money to grow. Financial literacy is not a luxury. It is a necessity. It is your right to understand money. It is your responsibility to learn. Knowledge is power, especially when it comes to your finances. When you understand money, you control it. You do not let it control you. This is a powerful shift, a shift you must make. This journey isn't just about numbers. It's not about getting rich quick. It is about building a strong foundation, a foundation for your future, a future where you have choices, where you are not trapped by debt, where you can pursue your dreams. This is why financial growth matters. It is about creating the life you truly desire. Are you ready to start? So, what are these things called stocks? It sounds complicated to many, but it is really quite simple. Imagine a big company, a company you know and like. Maybe they make your favorite phone, or your favorite coffee. When you buy a stock, you buy a piece. A tiny piece of that company, you become a part owner. Think about it, owning a part of Apple, or a part of Starbucks, or a part of Disney. It is possible for you. Yes, you. When the company does well, you can do well. If the company makes more profit, if the company grows bigger, the value of your tiny piece can go up. That is how stocks can build wealth. When a company is successful, its stock price often rises. This means your share, your piece, is worth more. You could sell it for a profit. Some companies also share their profits. They share with their owners. These are called dividends. So you can make money in two ways, from the stock price going up, and from dividends paid to you. This is the goal. But let me be very clear. Companies can also face problems. Their profits can fall, they can make bad decisions. If the company does poorly, what happens? The value of its stock can go down. This means your piece is worth less. So, investing in stocks has risks. You must understand both sides, the potential rewards and the potential risks. Now let's talk about mutual funds. This is another way to invest your money. What is a mutual fund? Imagine a big basket. This basket holds many different investments. It can hold stocks from many companies. It can also hold other things like bonds. Bonds are like loans you give to a government or company. They pay you interest. A mutual fund is this basket. You don't buy the whole basket alone. That would be too expensive for most. Instead, you pool your money. You join with many other people. Everyone puts in some money. Together, you all own the investments in the basket. A professional money manager takes care of this basket. Their job is to choose and manage the investments. They try to make the basket grow in value. This is teamwork. One big advantage of mutual funds? Diversification. That's a fancy word. It means not putting all your eggs in one basket. If you own just one stock and that company does badly, you could lose a lot. But a mutual fund owns many stocks. If one company does poorly, others might do well. This spreads out your risk. It is a smarter way to invest for many. There are many types of mutual funds. So many choices. Some funds focus on growth. They invest in companies they believe will grow fast. These can be riskier but offer higher potential returns. Other funds focus on income. They might invest in bonds or dividend-paying stocks. These are often more stable. You need to choose funds that match your goals and match your comfort with risk. What is an SIP? SIP stands for Systematic Investment Plan. It sounds very official, doesn't it? But the idea is simple, and it is powerful. An SIP is a way to invest regularly. You invest a fixed amount of money, at regular times, like every month or every quarter. It is automatic. Think of it like this. You are putting money into a special piggy bank, but this piggy bank is for investing. Maybe you decide to invest $50 every month or $100 or whatever you can afford. The amount is fixed. The timing is fixed. This money goes into your chosen mutual fund, or sometimes directly into stocks, small amounts invested regularly. The beauty of an SIP is its discipline. It makes investing a habit, like brushing your teeth. You don't have to think about it much. You don't have to guess when is the right time to invest, because nobody can perfectly time the market. With an SIP, you invest in good times and bad. This is called dollar cost averaging. It can help reduce your risk and smooth out your returns over time. Starting an SIP is easy. You don't need a lot of money. That is a big myth, that you need to be rich to invest. Not true. You can start an SIP with a small amount. What matters is consistency, sticking with it month after month, year after year. Those small, regular investments can grow. They can grow into a very large sum over time. This is the magic of SIPs. Section 5. Unlocking potential, the bright side of investing. Why should you invest in these things? Stocks, mutual funds, SIPs. What are the real benefits for you? Let's look at stocks first. If you choose wisely, and you are patient, stocks offer the potential for high growth. Your money can grow much faster than in a simple savings account. Imagine owning a piece of a company that becomes a huge success. Your wealth can grow significantly. Mutual funds offer different advantages. Remember diversification, spreading your risk? That is a huge benefit, especially if you are new to investing. You also get professional management. Someone experienced is watching over your money. They are making the investment decisions. This can save you a lot of time and a lot of stress. Mutual funds make investing accessible to everyone. It's a smart way to start. And SIPs? We just talked about them. Their power is in making investing easy, regular, automated. You don't need a lump sum of money. You can start with what you have, even a small amount each month. This consistency builds wealth slowly but surely. It takes the emotion out of investing. No panic selling, no greedy buying, just steady, disciplined investing. This is powerful. The biggest benefit of all these? They help your money work for you. They help your money grow faster than inflation. Inflation eats away at your savings. If your money isn't growing, it's shrinking in real terms. Investing is how you fight back. It is how you build real wealth. Wealth that can give you security. Wealth that can give you freedom. This is the potential you can unlock. Section 6. From acorns to oak trees. Why starting early is your superpower. I cannot stress this enough. If you want to build wealth, real lasting wealth, time is your most powerful ally. More important than how much money you start with. More important than picking the perfect stock, time. The longer your money is invested, the more it can grow. This is because of something called compounding. It is like a snowball rolling downhill. It starts small but gets bigger and bigger. Compound interest is magic. It is your money earning money. And then that money earning even more money. Let me give you an example. Imagine you invest $100, it earns 10% in a year. Now you have $110. The next year, you earn 10% on $110. Not just $100, so you earn $11. Now you have $121. It might seem small at first, but over many years, decades even, the growth becomes explosive. This is the power of starting early. Think about starting in your 20s versus starting in your 40s. The person who starts in their 20s, even with smaller amounts of money, they can end up with so much more. Why? Because their money has more time to compound, more years to grow and grow. Waiting is expensive. Every year you delay investing, you are losing out on potential growth. Growth you can never get back. So what is my message to you, especially if you are young? Start now. Do not wait until you have more money. Do not wait until you know more. Start with what you have. Learn as you go. Even $25 a month, even $50 a month. The key is to start, to get your money working for you, as soon as possible. Your future self will thank you, profusely. Section 7, Real People, Real Riches, Stories of Success. You might think investing is only for the rich or for Wall Street geniuses. That is absolutely not true. Let me tell you about everyday people. People just like you who built wealth through smart investing. Consider Maria, a school teacher. She started putting a small amount into mutual funds through an SIP in her late 20s, just $100 a month. She never touched it. She let it grow. Today, Maria is retired, comfortably, all from those small, consistent steps. Then there is John. John worked in a factory. He didn't have a fancy degree, but he was curious about money. He read books. He learned about stocks. He started investing in solid, well-known companies. He bought stocks when he could. He held them for the long term. He didn't panic during market dips. John was able to help pay for his children's college education and build a nice nest egg for himself. He did it. You can too. These are not fairy tales. These are real stories of ordinary people achieving extraordinary financial success. They didn't win the lottery. They didn't inherit a fortune. What did they do? They made a plan. They educated themselves. They were disciplined. They were patient. They understood the power of long-term investing. They took control of their financial future. You have the same potential within you. It does not matter where you start, it matters that you start. It matters that you believe in yourself, that you believe you can do this. These success stories are proof that you don't need to be an expert. You just need to be smart and committed to your financial well-being. Their success can be your success. Are you ready to write your own story? Section 8. Navigating the waters. Understanding risks and staying smart. Now we must talk about something very important. Risk. Investing always involves risk. I will never tell you otherwise. Anyone who promises guaranteed high returns, run away from them, fast. There are no guarantees in the world of investing. It is crucial that you understand this. Before you invest a single dollar, you must be aware of the potential downsides. This is being financially responsible. Stocks can go down in value, sometimes very quickly. A company might perform poorly. The entire stock market might decline. This is called market risk. Mutual funds, even though diversified, also carry risk. Their value can fall too. The value of your investments can fluctuate. It will go up, it will go down. You need to be prepared for this reality. Do not invest money you cannot afford to lose, especially money you need in the short term. So, how do you manage these risks? First, educate yourself. Knowledge is your best defense. Read books, attend seminars, follow reputable financial news. Never ever invest in something you do not understand. If it sounds too good to be true, it probably is. Ask questions, seek clarity, understand the fees involved, understand the investment strategy, be an informed investor, not a gambler. Second, diversify your investments. We talked about this with mutual funds. Don't put all your financial eggs in one basket. Spread your money across different types of assets, different industries, different geographies. This can help cushion the blow if one investment performs poorly. And finally, have a long-term perspective. Don't panic during market downturns. Historically, markets have recovered from declines and have gone on to reach new highs. Patience and discipline are key. Disclaimer: all investments involve risk, including the possible loss of principal. Past performance is not indicative of future results. Please consult with a qualified financial advisor before making any investment decisions to ensure they are appropriate for your personal financial situation and risk tolerance. Section 9. Your journey to abundance starts now. You have learned a lot today. About stocks, about mutual funds, about S&Ps. You understand the power of starting early. You understand the importance of compound growth. You know that everyday people can achieve financial success. And you know about the risks involved. You have the foundational knowledge. The basic tools are now in your hands. The question is, what will you do with them? Will you let this knowledge sit unused? Fear can be a powerful barrier. Fear of losing money, fear of making a mistake, fear of the unknown. I understand that. But I want you to understand something else. Fear is expensive. The cost of inaction driven by fear is huge. It is the cost of lost opportunities, lost growth, lost freedom. You cannot let fear dictate your financial future. You are stronger than your fear. It is time to take action, not tomorrow, not next week, today, right now. Take one small step, just one. Maybe it's opening a brokerage account, maybe it's researching a mutual fund, maybe it's setting up your first small CEP. The size of the step doesn't matter as much as the direction. The direction is forward, towards your financial goals, towards the life you want to live. You can do this. I know you can. This is your life, your money, your future. You are the CEO of your own life. It is time to act like one. Make smart decisions for your financial well-being. Invest in yourself. Invest in your future. Create the abundance you deserve. The journey of 1,000 miles begins with a single step. Take that step today. Believe in yourself and start your journey to wealth. You are approved to succeed.